This is a bullish reclaimed order block. Okay, anytime you see price come down into a support level or another discount array and price moves away from the down close candle, this becomes a bullish order block. Okay, it's the down close candle. We want to look at the high and the opening price and the mean threshold of the body. Okay, so there's 3 reference points we're looking at. They're not zones, they're specific price levels. And when price trades through it, it activates this down candle as a bullish order block. At some point in time in the future, if price trades back down into it, we would reasonably expect to see this as a buying opportunity. Okay, by itself doesn't mean anything, but we have to have institutional order flow on higher time frames to build in the idea that this should be a buy. Otherwise, it's not going to be a buy. But say we take it as a long and it trades up and then falls through, and we lose all of the ground and trades back down below the bullish order block. It takes the stops out. If price were to rally back through the high of the down close candle or previous order block, once it trades through that same high of the down close candle or bullish order block, this order block becomes valid again. But it is not allowed to trade down through the mean threshold at that point. So the mean threshold is a very specific area, and you can have a trailing stop loss or initial stop loss that would be right below that by 5 pips or so, and then allow yourself to be in on a move that may unfold as a result of a previous stop run. Okay, so the basic definition is any bullish order block that's traded down through, it eats and consumes the order block, but trades back through it and comes back down, but does not trade through the mean threshold. This could be a reclaimed bullish order block. Ideal scenario is to find a low that forms above the mean threshold, but we would permit it to trade to the mean threshold, but it cannot trade through it. If it does, most likely it's going to be wrong or it's continuing lower. Okay, so this is a reclaimed bullish order block. Okay, folks, now we're looking at a reclaimed bearish order block. And the assumption is this price at some point moved up to a high or a bearish premium array, creates the last up close candle. When price trades down through it, it validates it as a bearish order block. Price trades back up to the low or the open of the candle. This is normally our sell scenario. Price starts to trade lower. If it doesn't trade lower and just trades back up through it, anytime the bullish candle, which would be anticipated as a bearish order block, its high is taken out and runs the stops above that order block, we would have to wait to see if it trades back down through the low of the up close candle or potentially or anticipated bearish order block. Once the low is violated, it becomes a bearish order block again, and it's valid. But the problem is we cannot permit price to trade back to the mean threshold. It has to stay below the mean threshold preferably, but it can touch it, but we cannot see it trade through. Normally, we would let the first pass through an order block to get to the threshold, the mean threshold of the middle of the candle. That's not permissible once it becomes a potential reclaimed order block. In this case, once we get back above the low, that becomes now a opportunity to get short, and we would anticipate a run lower. Our stop could be 5 pips just above the mean threshold at that time. The key is look for the run above the order block as a stop rate, and it's validated after price trades back down through the last up close candle. And if that happens, we can see it's validated again once it trades back through the low, comes back inside the body of the candle. Look for some short. Stop can be above the mean threshold, and we look for expected move lower. Classic manipulation pattern, still using institutional order flow. This is the hardest one people get tripped up on because they think they understand the order block up close, down close, and just buying it at the open or the high or selling at the open or the low. It's not that easy. You got to understand the context behind the market, so that way the market maker's storyline and context can be discerned, and then you can take advantage of that